So we're going to look at Penn Gaming, and we're going to do a discounted cash flow model in this company. This is how we find the intrinsic value of the stock to see what it's worth using the company's financials. Now, what is the market cap? It's 4.13 billion, and the share price is 30.38. So when we calculate the intrinsic value of the company, then we have to divide that number by 136 million shares to come up with the stock price. And if the stock price is above $30.38, we consider it a buy. And if it's below $30.38, we consider it a sell. So let's look at the free cash flow. Free cash flow is the cash that's left over after operating the business each year. So this is a really important number for people to look at. It's on the cash flow statement. I don't think a lot of people focus on the cash flow statement. They focus more on the income statement and balance sheet. But this number is vitally important because this indicates whether the company has a positive cash flow or negative cash flow in a given year. Net income on the income statement does not do that. There's a lot of accounting things going on. So they do have positive free cash flow each year. It looks fairly healthy. Now let's look at the net income. And the reason I say net income doesn't do this is because on the income statement there's a lot of depreciation, there's a lot of losses people take. There could be manipulation of things, so it's not the clearest picture. You have to look at, it's kind of like a puzzle, a company. You have to look at every little piece and put it together to see the entire picture. And that can be really difficult if you don't know what to look for. That's why you just got to do it, and then you keep learning as you go. So they have a really nice pop in revenue in 2019. That's a really good sign. So let's look at the capital structure, because we want to see how much it costs them to get money through equity and debt financing. Now, their interest expense on their debt is $500 million, and let's see how much debt they have. And on their current liabilities, they have 62 million of current debt, so that's debt due within a year. And then the non-current liabilities is the debt that's due beyond a year. And that's usually a lot bigger. And you could check the 10K to see when this debt is due. It's good to know if it's due next year. That makes a big difference between due next year and due in 5 years. So their effective tax rate is, wait 1 second. The long-term debt, 2 billion, current debt. So their interest expense. So this, I've never seen this high of a debt payment. They pay 22% interest on the debt. They must be a really risky company to lend to. That is a really high interest payment. That's a little concerning, but let's keep going forward. What's their income before tax? And now their income tax. See, look at these numbers. The income, I'll put it into the model. Oh boy. So it indicates that they pay 50% of their profits in taxes, because the income tax is roughly half. That's in 2019. In 2018, they had a negative income tax, so they got a refund on more revenue. So this is why it's hard to look at the income statement. It doesn't really make much sense if you think about it, because what happens on like earnings on your income statement, there's so many things that can happen. Like for instance, companies use accrual accounting, so they have to match the income and expenses, and as opposed to doing cash accounting, which means when cash comes in, that's when we record it. So if you can hold on to the cash on your balance sheet and report it when you want to report it, you can really manipulate things. And I'm not saying they are. I'm just saying it just makes things a little more difficult to analyze. So I'm going to just force a 20% effective tax rate because that's generally the average, and I think that would be appropriate. So this company, even though they paid 22% on their debt, they get a tax deduction, so now it's down to 18%. So let's see the cost of equity. And we need the beta. See, I had a feeling that's a pretty high beta, 2.31. Anything over 2 indicates a really volatile stock. So it moves more than 2 times what the market moves. And you don't want that in a stock, such a volatile. So it cost them 20% the cost of equity. That's how much it cost them to obtain equity, which equity means common stock. And then the debt is 18%. So this is obviously a risky company because they have to pay such a high rate to get money. And their weighted average cost of capital, I've never seen it this high, it's 19.29%. So that means anytime they move forward with a project, they need a return of at least 19% just to break even. So they got to break 19% to start making money. So if they take on a project and have an 18% return, they're losing money. I guess in the gaming industry, they have high margins. But so we have the WACC, and we calculated the future free cash flow, and we extrapolated it in the model based off of their actual financial information, and we discounted it, and it has a pretty significant discount because it's such a high WACC, such a risky company. And when you sum up the future free cash flows, it's $3.2 billion. And so this is a really conservative situation because we're forcing them to borrow at such a high rate. And if we divide that 3.2 billion by the 136 million shares, we estimate their stock price at $23.40, which isn't far off from where they're trading now. They're trading at $30.38. And it's really interesting to look at the stock price the past 5 years. Before Corona, they were up to about 40 a share, it looks like. And then pre-Corona, they were trading about at intrinsic value, because any equity analyst that works at these big investment banks, they could put these models together and come up with a similar number I did. And that's how they say, okay, this company's a buy, this company's a sell, this company's a hold. So people know where the intrinsic value should be based off of those types of analyst reports. Now, why would a company be trading so far below intrinsic value at this point in March and April? Because coronavirus hit. A company that has resorts and casinos isn't making any money, so they don't see the future, at least the immediate future, so great. The stock did come up. Now it's selling at a premium. It's trading at $30.38, which according to our model, it's a sell because we calculate $23.40. So the market is seeing the future of this company obviously improving because they're paying a premium, and it's really interesting because I wouldn't think a stock like this should be trading at a premium, but that's really for you to decide. You're the investor. I'm the analyst looking at it. You also have to decide and make your decisions. Let me know in the comments what you think. Do you think this company is worth $30, or do you think it's closer to my intrinsic price of $23? And thanks for watching the video.